What's up everyone? So welcome back to the channel. This video is going to be a guide on how to generate income by selling options. So before we get into the video, I hope you guys already know the basics of call and put options. If you don't yet though, I have a video in my channel that I have covered all this and I'll provide info to it in the description. Of course, there are plenty of other sources you can get information from too, but I think my video is going to be the best for that. Let's get straight into it. Now, before I introduce you guys to selling puts, let me quickly remind you what happens when you buy a put option. When buying a put option, you get the right but not the obligation to sell short a stock at the strike price. You are risking the premium you pay for the option and are betting on the downside on the stock. You can also sell to close this option anytime before the expiry date for a profit or a loss. But when you are selling an option, you are taking the other side of the contract. You are selling to open the contract. This means you are the market maker here. You are the house, which means you are most likely to profit. When you sell the option, you get to collect the premium upfront that is yours, unless to buy to close at a higher price. On an average, 90% of the options expire worthless. That means you are very likely to make money when you sell an option. Most of the time it's free money. But remember, you will be obligated to buy the stock at your strike price if the price goes below it at expiry. This strategy involves selling a put option at a lower price than the current price of the stock, and you get to collect the premium on that contract. The most common scenario where you use this strategy is when you already have identified a stock that you want to own, but you're in no hurry to buy it. You have done your due diligence on the stock, you have done the necessary fundamental analysis, and you think it's a sound investment. Quick note here, I will be doing a fundamental analysis video in the future, so stay tuned for that. Back to the video. To be able to sell the put option, you should have enough cash in your account to cover the purchase of the shares of the strike price. Meaning if you sell one contract, you will have enough cash to buy 100 shares at the strike price. That's why it's called a cash secured put. You can also always close the contract before the expiry for a profit, or let the option expire out of the money and pocket the whole premium. If an option is in the money at expiry and the contract is still open, you will be forced to buy the stock at the strike price. So now let me take you guys through an example or illustration to show you guys how this works. So let's say we have a stock that's trading at $100 currently. So right here, I'm showing you options that expire in 2 weeks. You want to buy 100 shares of this stock, but there's a chance it may go down in the short term and you don't mind buying it at a lower price, say 90 here. So you sell the $90 strike put option. Since the option is currently trading at $1.50, selling one contract will make you $150. But remember, to sell this option, you will have to have at least $9,000 cash in your account to buy the 100 shares. This option will rise in value as the stock goes lower and drop in value if the stock stays where it is or goes higher. As long as the stock stays above $90, you can close this option for a profit. Say the stock goes up to $110 tomorrow and this option decays to 50 cents. You can take the profit of $100 and close your option contract. When the option expires, and if you still hold it and the stock is below $90, you will be assigned the stock. Say after option expiry, the stock is trading at $89. You will end up buying the stock at $90 since you have already received the $150 to sell the option. This is the equivalent of buying the stock at $88.50 2 weeks later rather than buying it at $100 price on the day you sold this option. So a personal experience that I've had with cash secured puts is AMD earlier this year, I would say May. So after AMD's earning report, the stock ended up tanking to about low 80s, about $81. I ended up selling the 78 put a week or two out, and I ended up collecting a good amount of premium. So my plan was, I'm gonna buy the shares lower But what happened later was the stock ended up never going below 80. So the stock just rose from there, and I made the full premium that I sold the option for. I kept it, and it was a really good trade for me. So that's a good example to show you guys the power of cash secured puts and how it's a great income generating strategy. To summarize all of this, selling puts is an income generating strategy. You can make money for free while you wait to buy a stock which you want to buy anyway at a lower price. The risks involved in this are that the stock may fall due to a big unforeseen reasons, which would remain if you were buying the stock. Another risk is that the stock may run up too fast and you may not get an opportunity to buy at your price. You should only do this for stocks which you have done fundamental analysis and technical analysis on. This can be risky to sell on some stocks which can get really high premiums but pose the danger of going down rapidly. If you play this strategy correctly, this is a strategy to generate income, which can be very useful in your trading and investing journey. So that's all for today's video. Please make sure to like this video and subscribe to the channel if you enjoyed it. And my next upload should be coming pretty soon. I'll see you guys in the next one.